So good morning and welcome everybody. My name is Heather Liston. I'm going to be talking about retirement savings plans, particularly the best retirement savings plans for you. So I want to mention that the chat box is open and you are welcome to put questions in anytime. I'll try to check it periodically throughout. And in particular, because we are a relatively small group this morning, um, almost anything you want to ask is fine. I usually try to keep it as much on topic as I can, but we are small enough that if you even think of a tangent, it's okay to ask questions about it, and I'll see if I can help. So, our goal today is to talk about best retirement plans for you. And I want to mention there are quite a few options in the tax code these days to help you save for retirement. Doing something is almost always better than doing nothing. So, I hope that we will find something that will work well for you. First of all, this is me. My name is Heather Liston. I run a financial planning firm in San Francisco. It's called Clarity Financial. I am a certified financial planner and also an enrolled agent. I realize not everybody knows that second term. So I'll tell you, an enrolled agent is a qualification bestowed by the IRS. It means I've taken a series of tests to show that I'm competent in income tax. I do both financial planning and income tax, although I'm not here today to drum up your business. I'm pretty busy as it is. So, really, our goal is to get you all the information we can today. If you want to contact me later, though, my email address is hcliston at clarityfinancialca, as in California.com. And my website has some interesting resources and things on it if you ever want to visit that, clarityfinancialca.com. I will tell you, if you do visit my website, don't worry, I'm not collecting your information without your knowledge or anything like that. You're welcome to peek and lurk and disappear. And Elsie is reminding us that she's recording this session, so you can look at the recording later if you want to. And I also want to mention very often people put in the chat, can we have a copy of your slides? The answer is yes. Don't worry about that. After the session, I'm going to send Elsie a PDF of all my notes and also a couple of other documents that I think might be useful to you. So don't worry about asking for that. You will get them if you want them. A couple of other background things. I'm going to talk about general examples from real life, but obviously, I don't know your whole specific situation. Tax laws are complicated and they change frequently. So definitely everything I tell you, I'm quite sure will be true, but you want to be very careful about exactly what applies to your situation. And if you have a financial advisor of your own, run any ideas by them, or if you have a tax professional. If you've seen me speak before at one place or another, you may have seen this cartoon before because it's one of my favorites by Roz Chast of The New Yorker. Just a bunch of people sitting on a sofa, and one young girl says, Grandpa, tell us again about pensions. The reason I like this so much is in our parents' and grandparents' generations, there were pensions for a lot of people. And that meant you would work at the same company for a long time. And then when you retired, they would continue to pay you something, either your whole salary or half your salary or something. That has gotten pretty uncommon now. And particularly for you, I think a lot of you are probably self employed. You're not going to have any pension. You are the company. But even for most other people, it's not really a thing anymore, that historical pension. And by the way, in the business, we call that type of pension a DB plan, a defined benefit plan. What that means is the old style pension means your company would promise to pay you X dollars a month for the rest of your life, no matter what. And then it's not your problem where they come up with the money or how they invest their savings. They just owe you that money. That's why it's called defined benefit. Your benefit is defined. What's much more common now are what we call defined contribution plans or DC plans. A 401k, for example, is a defined contribution plan. What that means is you know what you contributed because it's your savings. You put the money in. What comes out, though, nobody can guarantee because a lot depends on how much did you save and how did you invest your savings and things like that. There's no guarantee what you're going to get. So a lot more of our retirement income now is in our hands. We have to take care of it ourselves. There's no big brother, no company that's going to do it for us. Here's a list of things I want to talk about today. One is, why are we talking about this? Why is all this worth the trouble and complications? And you will find it can get complicated. We're going to look at an overview of plan types, particularly 401ks and IRAs. Those are the two big categories. of self savings for retirement. And then Roths and pre-tax are two subsets of both of those categories. We're going to then get into some details about various types of plans, including I highlighted in blue here because I think this might be most relevant for you, the small business plans, which are primarily SEP IRAs and solo 401ks. Those are the most popular types for self-employed people. We'll talk about for all of them, who's eligible, what are the income limits, what are the contribution limits, what are the withdrawal rules. Then I have some good news about a credit for people who are saving in retirement funds. We'll talk about required minimum distributions. People in the business like me tend to say RMDs all the time. Occasionally someone will remind me they don't know what I'm talking about when I say RMD. So that means required minimum distribution. That means at a certain age in your life, usually 75, but sometimes a little earlier, you are required to start taking money back out of your retirement plans and probably paying tax on it at that point. If we have time, then we can talk about some more advanced maneuvers like a backdoor Roth or a mega backdoor. But again, I'm most concerned about making sure that we answer what you're interested in. And it's quite possible that those two last topics aren't even relevant to you. So we'll see when we get there. So now I want to really ask, what do you want to know? And I'm going to put my glasses on and look in the chat. So please tell me in the chat now if there's anything in particular on your mind that you want to make sure we get to, or that you're really confused about. Looking, so far all I see is Elsie's notice about the fact that she's recording and she's going to share it with you. Nobody's contributing? Okay, I'm going to keep the chat open. So do let me know if there's something on your minds or something you want information about. But meanwhile, I'll go ahead and move on. Oh, good, one new message. Somebody says, how does the retirement fund affect Medicare? Oh, interesting question. Okay, I'm going to jot that down so I don't forget. Okay, a couple of things about Medicare. First of all, Medicare is complicated, as you probably know, and it's not our main topic today. So I'm not going to go into all the details about Medicare, but as it overlaps with this, a couple of things to know. One is Medicare starts for everybody at age 65. Social Security now is not the same age for everybody. For anybody born, well, to go into all the Social Security rules would also be complicated, but for anybody born 1960 or after, your primary retirement age for Social Security is 67. That varies. We can take Social Security anytime between age 62 and age 70. Medicare, no. Medicare, everybody's 65 is the age. So that's the first thing I want to mention. And then the amount of Medicare that you have a right to doesn't change based on your retirement planning and things. But what I think this person may be referring to is what we call IRMA. And someday I will memorize what IRMA stands for, but I'll tell you what the letters are: IRMAA. And IRMA is the extra charge that you pay for Medicare if you are in a relatively high income bracket. So a few other brief things about Medicare. Medicare Part A is for hospitalization, and you have been paying into that your whole working life. If you look at your paychecks from any job you have, there will be a small line item for Medicare, or else it'll be bundled under FICA, which is Social Security and Medicare. So you've been paying for Part A your whole life. So Part A does not cost any more when you are eligible for Medicare. But Parts B, which is for doctors, and Part D, which is for drugs, prescriptions. Parts B and D, you pay a basic monthly fee. For Part B, for example, right now of Medicare, I think it's $202 or something like that, $202.90. But if you are in a higher income bracket, you're going to pay a little more for Parts B and Part D. Part D is a low price anyway. That's in the like $10 range. But you pay a little bit more depending on your income, your taxable income in the year that you are getting Medicare. So how is that even related to what we're talking about today? I'm guessing this person who asked the question has already started getting involved in this, and because it's a little bit complicated, but one thing that makes your Medicare IRMA go up, that's the additional charge you pay for Parts B and D. It will go up if your income is higher, and your income might be higher because of RMDs. So required minimum distribution is the amount of money you have to take out of pre-tax retirement funds at a certain age. And let's say you're 75 years old, you have a large amount of money in a pre-tax retirement account, you do a calculation, you figure out what is my required withdrawal amount, and then whatever that is, maybe it's $100,000 of withdrawals that year, you pay tax on that, and that counts as income, which then makes your Medicare costs go up. Now, one of the ways you can help manage that is if you smooth out your income so that, let's say you retire at age 50, that would be nice, right? If you retire at 50 and your required minimum distributions begin at 75, there's 25 years in there where you may have a relatively low income. During those years, if you start taking money out of your pre-tax accounts, then you won't have to take out quite as large amount when you are Medicare age at 65. You won't be or later at 75, you won't be taking out such a large amount to make your income go up and make your Medicare costs go up. Now, I realize that's a little complicated, and I'll mention Elsie and I were talking at the beginning about this, about like, oh, what might we do next year? So I will tell you, I could certainly do whole presentations on Medicare and on Social Security if people are interested in those things, which you probably are. We all are. They're important. So that might be useful. Oh, someone just said yes. Thank you for that vote. Yeah, I would love to talk about Medicare and or Social Security. They're quite complicated. But I know that quick overview I gave may or may not have helped answer the question for the person who asked about Medicare. So one thing I just want to add about that is Medicare is a good deal no matter what. I am self-employed. I'm betting some of you are self-employed. If you have to buy your own health insurance like I do, I'm guessing you know it's outrageously expensive. I pay a fortune for my personal medical insurance, and mine covers almost nothing. I pay out of pocket for almost everything, in spite of the fact that I buy health insurance. So I'm very much looking forward to being on Medicare because once I get to Medicare, the costs are so much lower. Even if you have a high income and you're paying some of those premiums for those extra steps because of IRMAA, income something adjustment, I don't know. Anyway, most people call it IRMAA. But even if, let's say I had a very high income and I had to pay more for my Medicare, still going to be a way better deal than me buying my own health insurance through the ACA exchanges, or interestingly enough, I am buying it through a realtor association right now. And so I get a better deal than if I weren't doing that. But health insurance on your own is very, very expensive. Medicare is a good deal no matter what. So I'm trying to help people not be too overly concerned about IRMAA. Sometimes people get very upset about those extra charges that they pay for their income level at retirement for Medicare. I just want to remind you, Medicare is a really good thing. And those extra amounts that you pay, they don't wreck it. So don't worry too much about having a relatively high income in your later years. It's okay. Okay, I see another question. Somebody says self-employed 401k. Great. You're right on my wavelength. We're going to talk a lot about those. That's a really good thing to have. And FYI, you may call it a solo 401k. That tends to be the term I use most often. People actually call it a lot of different things, but that's very important and a very good idea. And somebody says, can a corporation invest in a Roth IRA? Interesting question. I'm wondering if that person means an S Corp, because an S Corp is a common business type for small business owners. And if you mean an S Corp, then you as an individual have earned in. Oh, somebody says C Corp. Okay. C Corps are bigger companies usually. They're more complicated. They're big companies like Apple and IBM. Those are all C Corps. Can they have an IRA? Not exactly. Now, a C corporation, any company can offer a 401k, and a 401k these days usually has a Roth option. So in other words, if your company has a 401k, you can allow your employees to contribute either the pre-tax portion or the Roth portion of the 401k. It's not an IRA, but it does have a Roth. Let's see, someone says, oh good, this is Elsie just reminding us that we're going to post a video and send notes later. Okay, thank you so much for those questions. I'm going to start moving through the slides that I prepared, which I think will answer some of those questions. And you should continue to put things in there as they come up. I'll check periodically. All right. So why do these retirement plans exist? Because, theoretically, we could all just put money under our mattress, right? We don't have to have all these shenanigans. The answer is, and I often get choked up when I say this, Senator Paul Wellstone of Minnesota, the late Senator Paul Wellstone, had a saying that we all do better when we all do better. In other words, it's in everybody's interest. If you are taken care of in retirement, if your neighbors are healthy, if your children are fed, we all do better. So retirement plans and the tax breaks and things that are available to help us and encourage us to save in retirement plans, those are because we as a society are all better off if nobody goes hungry and if everybody's taken care of. So the tax code and the US government have made possible these retirement savings plans. Now, it might be nice if they just gave us money, right? That's not the way things work these days. Even Social Security these days is usually quite a small part of what people need during retirement. But by making it, I hope, easy, by making it possible to save taxes and save money in an organized way, we help ensure that the country in general will be in better shape because people will be in better shape. So again, what makes it worthwhile to learn about all these retirement plans? Two big reasons why we bother with all these retirement plans. Number one is the tax advantages. You probably finished your 2025 taxes recently. We all grumble about it, right? Paying taxes isn't fun. So with retirement plans, some of them let you save taxes now. Those are generally pre-tax plans, sometimes called traditional. So a traditional IRA means you don't pay tax on it now, you pay tax on it later when you take the money out, or a pre-tax 401k, sometimes also called traditional. Those you save taxes now. Then there's this other broad category of plans where you save taxes later. Those are often called Roth as opposed to traditional. Roth accounts mean you do not get a tax break when you put the money in, but it grows tax free for the rest of your life. So you never pay tax again on any earnings or growth or interest or dividends in a Roth account. So some retirement plans we save taxes now, some we save taxes later. In both cases, it's usually substantial. It usually makes a big difference in your life and your financial plan. So that's reason number one. We have retirement plans. Reason number two, systematic savings. If you have a 401k at work, you do not have to think about it very often. At the beginning of the year, you sign some form and say, yes, withhold X dollars from each paycheck. Your company does. It goes into your 401k plan. It gets invested. And you don't really miss the money because you don't have to take it home and then think, oh, can I spare this? But wait, I'd rather buy that shirt. I don't want to save it. It's automatic. That's fantastic. We get the less thinking we do in general, the better decisions we make. You don't forget to save. You also, when it comes to investing money, if you're doing it automatically through a 401k or any type of plan where it's being withheld on a regular basis, you avoid the temptation to try to time the market. And timing the market means looking at things and saying, oh, looks like it's a good day to invest. And I'll tell you, studies have shown that no matter how smart you are, no matter how many degrees you have, or how much time you spend studying the stock market, people always tend to get that wrong. Even professionals get that wrong. When we try to time the market and decide what's the right day to invest, we don't get it right. One reason, if you just think about it sort of simply, is days when stock prices are high, like yesterday. Yesterday, all of a sudden, everything was up, up, up. That feels really good, right? We feel excited. We think, oh, I want to be in the stock market. Let me put more money in the stock market. Could be the highest it's ever going to get. We never know. But that's probably the wrong time to buy. Other times when there's a big crash or a dip, like 2008 when everything was on sale, or right after the pandemic was really noticed in March of 2020, all of a sudden there's this huge dip in the stock market and we feel scared. We feel like, oh, I don't want to be part of that. I'm going to put my money under the mattress. I'm going to put my money in CDs or something safe. Those are exactly the right times to buy when everything's on sale. Remember, we want to buy low and sell high, but that's not what our gut tells us. So we tend to get market timing wrong. What's great about doing your investing through your 401k is Same amount of money goes in every 2 weeks or every month or however often you get paid. It goes in on a regular basis. And then you take advantage of dollar cost averaging, which means because we don't know what's the best day to buy an investment, usually the best way to do investing is to buy a little bit every day or every week, to just do it very regularly. So you buy some at one price, some at another price. You don't risk buying on the wrong day. A 401k makes that absolutely automatic, which is great. So these are the two big reasons why we spend so much time focusing on retirement plans: tax advantages and systematic savings, both of which are incredibly valuable, especially over time. Some important rules: it's always good to reduce your taxes. And when you have money withheld from your paycheck, you don't miss it as much as you think you will, because you never see it in the first place. So that can be helpful. And also, because it's tax deferred, if you're putting money in a traditional 401k through your paycheck, you are not reducing your paycheck by as much as you are increasing your savings. I have a little example about that later. But the reason for that is when it's being withheld from your paycheck and put into a pre-tax account, you're not being taxed on that money. So your paycheck does not go down by as much as what you're saving. Another rule of the universe: if you have to pay tax, paying later is better than paying sooner. All right, reasons to participate: tax deferred contributions, tax deferred or tax free savings and growth, automatic savings, the chance to retire someday, and because it's a valuable part of your compensation. If you work for a company, now if you're self employed, again, things are a little different. And I know that I am, and many of you are, but if you are working for a company and somebody else is paying you, they're paying the fees for this retirement plan. They've organized it. They're offering it as part of your compensation package, and you should take advantage of everything that's available to you. Reasons not to participate: I have been an HR director in past jobs when it's my job to get people signed up for the plan. A lot of people don't sign up, even though they really, really should. So I collected some of the reasons. Okay, this isn't a real one. You enjoy paying as much tax as possible. Nah, of course not. You already have so much money you can't imagine what to do with more. I don't think that applies to anyone either. And not just us. That doesn't apply to anyone. Even rich people are always trying to get more. You love your job so much you hope you never have to retire. Okay, real reasons people don't participate: they think their spouse is better at stuff like this. And I can tell you, when I was an HR director, I heard that a lot. I'd sign up a new person, get all their forms filled out, and then say, okay, now you really should sign up for the retirement plan. Here's how you do it. I got to check with my wife. She handles all that. So I understand. I certainly do agree married people should talk things over, but really, you're the smart one. You can do it. And if you do need to discuss with somebody else, actually, when it comes to retirement plans, what I would suggest, if you are one of those people who says, oh, my wife or my husband or my partner or somebody else understands this better, I want to talk to them, what I would say is go ahead and sign up now anyway. You can always change it later, but it's better to get started. Okay, another reason, one of the big reasons that people don't join a retirement plan is they don't know which funds to invest in. And they think, oh, I better wait until I have time to research that. One client even said to me, oh, I don't think I understand the stock market yet. Well, guess what? Nobody understands the stock market, and it's still better to be in it than not to be in it. So it's better to do something than nothing. And there is an easy way. If you're signing up for a 401k plan and you don't know what to invest in, you can just choose a target date fund. I'll talk more about those later in case you're not familiar, but those are funds where somebody else, Vanguard or Schwab or Fidelity or somebody like that, just puts together a group of investments that's a perfectly reasonable mix. So you don't have to overthink. You don't have to think, oh, do I want to invest in, this or that? You just get this reasonable mix for your age group and you're done. You don't have to think too much. And there are more interesting things to do today. Wrong. This is super interesting. It also doesn't have to take long to get your retirement account started. And some people just say it's too complicated. And I'm sorry to say, yes, it does get complicated. They keep changing rules. They keep offering new types of plans, but we'll focus on the important steps. And there are fairly simple things you could do to get started. All right. Again, this is a repetition. We do this because of systematic savings and tax shelters. All right. First, really key concept, which I alluded to before: tax-free versus tax deferred. Tax deferred means you don't pay tax now, but you pay tax later when you take the money out, probably after you're retired. Tax-free means probably no tax savings right now, but the money grows tax-free for the rest of your life. Those tax-free accounts are often called Roth. Tax-deferred is often called traditional. Yep, good. I had a slide saying just that. Roth is named, by the way, after a senator, Senator William Roth, who came up with this idea of that type of plan around 1998. So they've been around for a while, but Roths are getting more and more popular. People are even more eager to get more money into Roths now than they ever were before. And it can be a very good deal, especially if you are young. Your Roth money has a lifetime to grow, which is fantastic. If your kids are working, I would definitely try to start a Roth IRA for them. They have to have earned income. But as long as the child has earned income, there's no age limit. And then they can start putting money into a Roth IRA. And if you put in, say, $5,000 now and it grows tax-free for 40 years, it's going to be a lot of tax-free money. So that can be fantastic. Now, for all of us, Roths are good, but in certain other situations, traditional might be a better choice, but they're both good. So that's the point of this slide. Which one is good? How do I decide? And the answer is they're both great. So that is another thing I don't want you to waste too much energy and time worrying about. Like, oh, I can't contribute to an IRA because I don't know which type to do. Just do something. They're both great. Now, if you have to decide, let me see if I have a slide. No, if you have to decide which is better for you, in general, the Roth is best if you are young because you've got so many years for tax-free growth. The Roth is also good if you are in a low tax bracket. Let's say I'm just earning a little bit of money this year. My marginal federal tax bracket is 10 or 12%. I might as well pay that tax, knowing that I'm going to be successful later in life, and I might be in a 37% tax bracket when I'm taking the money out. Better to get it in locked in at today's low tax rates, let it grow tax-free forever. So again, if you are young or you're in a low tax bracket, Roth is an obvious choice. If you're in a very high tax bracket now, then I would do the tax deferred. I'm in San Francisco, as I mentioned, so a lot of my clients work in Silicon Valley, and I don't know if you've heard, but some of those compensation packages are enormous. If people are working for, say, Apple or Nvidia or Amazon, and in addition to a hefty salary, they're getting stock, which is taxed at ordinary rates as well. They may have an income of $1 million or more. In that case, I want to pare down their taxes right now as much as I can. I want to reduce their taxes in the current year. So I will say, let's contribute to the pre-tax and max that out and then look for other opportunities. So those are the broad categories. If you're in a high tax bracket right now, do pre-tax, traditional. If you are in a low tax bracket or you have a very long time horizon, do Roth. If you can't decide or you're somewhere in between, do some of both. I always love the wishy-washy approach. Some of both makes perfect sense. And then you're more flexible. And later when you're taking money out, you can decide which ones to take money out of. So I mentioned a little earlier that if you have money withheld from your paychecks, it might not feel like as much as it sounds like. So here's the reason. Let's say you're saving in a traditional 401k. You have $200 withheld from each paycheck and put into your pre-tax traditional 401k. Your take-home pay is not reduced by $200. I did a little math using, different salary levels and found that the take-home pay for people would be reduced by somewhere between $108 and $161, not $200. The reason is that both your tax withholding for federal and state is also reduced when you have money withheld from your paycheck. So your paycheck doesn't go down by quite that much because your taxes go down. So that's nice. Then you invest the money in your 401k and you watch it grow. And later, when you're retired, you start taking the money out, you pay tax on it then, when ideally your tax rates are lower. If you've stopped working completely and you haven't started getting Social Security or required minimum distributions, your tax rate's going to be low. And then you can take this money out. And number one, you're going to be paying at a lower rate. Number two, you're also going to be paying way later. And remember, it's always good to pay later instead of sooner if you can. Okay, the Roth example, you would have $200 withheld from each paycheck and say put into a Roth 401k. Your take-home pay will go down by $200 because when you save in a Roth account, you don't get a tax break now. But you will then invest that money in your Roth 401k, you watch it grow. When you take it out years from now in the future, you pay no tax at all. Doesn't matter if the account has earned dividends, interest, capital gains. Doesn't matter if you invested it all in Apple or something like that and it tripled in value. No tax at all. Fantastic. Okay, now we're going to get into an overview of plan types. But first, I'm just going to peek at the chat again and see if I missed anything. Nothing new. Okay, so we will focus on the things I already know you're interested in. All right, business and personal. So for individuals, we have the traditional IRA and the Roth IRA. You do not need a company to help you do that, but you do need earned income. Then we have, if you have a regular job where somebody else is paying your paycheck, you may have a 401k. That's by far the most popular type of workplace plan. A 403b is almost exactly like a 401k, but it's only at government agencies or nonprofit organizations. Those organizations might have a 401k, but they can have a 403b. Doesn't make much difference. In the past, there used to be more of a difference between these two types of plans. Right now, anytime I say 401k, if you have a 403b, I mean you too. Okay, 457 is a little bit more unusual. They are only for nonprofit organizations and government organizations. And we probably won't dwell on that today unless anybody tells me that it does apply to you. A 457 is a great opportunity, but I'm guessing most of you don't have one. And a 409A is even less common. That's sometimes called a deferred compensation plan. Those vary greatly. They're usually just for high-level executives at C corporations, and they're very different. In other words, if you have the access to a 409A plan, again, sometimes called a deferred compensation plan, I want you to get your summary plan description and read it, or give it to your financial advisor to read, because they don't all work the same. So we'll focus more on the most common type, which is 401ks. Now, then we talk about small business plans. There are three main plans for small businesses. The third one is the least popular right now, the Simple IRA. And by the way, Simple is an acronym. Doesn't really mean it's simple. It is easier than the others, but the two most common are the SEP IRA and the Solo 401k. And we're going to talk about details of both, but I'm just going to tell you right off the bat, if you work for yourself and you have no employees, a solo 401k is the right way to go. If you own a business and you do have some employees, then you're not eligible for the solo, and then you should do the SEP IRA. They're both great plans, but that is the major difference. If you have no employees, do the solo 401k, also known as a self-employed 401k. If you have employees, do the SEP IRA. They're both great. Okay, more about all of that. I have another question for you. How many of you, and let's see, maybe we can do this with raised hands. How many of you are self-employed? If you could click that raise hand button at the bottom of your Zoom screen, that would be great. Or, I know not everybody's super familiar with Zoom. If it's easier, tell me in the chat if you are self-employed. Okay. How many of you work for a company? And if you work for a company and you're not self-employed, that means you get a W-2. So raise your hand through the raise hand or type it in the chat if you work for a company and get a W-2. People aren't being very responsive. Raise your hand if you're alive. Okay, good. We got one new message. I really want you to participate, by the way, because I could talk all day, but it's not. Oh, good. Two people say self-employed. Good. That's what I was guessing, is that many of you probably are self-employed, as am I. So I really like talking about that. And by the way, a quick detour on that. I sometimes work with people who don't even realize they are self-employed or don't realize they're a business owner. To be a business owner, you do not have to have set up an LLC. You don't have to have an S corp. All you have to do is earn some money that's not coming through another company. So if someone gives you a 1099, you are self-employed. Good, I'm getting some more responses for self-employed. Anytime you get a 1099 or anytime you get paid and you don't get a W-2 and you're not working for somebody else, you are self-employed. Like, for example, I worked with an Uber driver. And he's like, oh, I'm not really self-employed. I just, but yes, you are. You're running your own business. Or a woman I work with who makes jewelry and sells it. Yeah, she's self-employed. You don't have to set up a structure for that. As soon as you're earning money, you're self-employed. Okay, so that's good to know. We are going to focus on that. Now, since I'm seeing you're a little shy, I'm not going to keep demanding you enter answers here. But these, again, are the two most common types, the SEP IRA and the solo 401k. I'd be curious if people have those already. We're going to talk about which ones I think how they work and which ones you should probably have. And the reason I was stumbling a little is I was thinking another group of realtors I spoke to a few years ago, not you guys, not as sophisticated as you guys, but I was working, it was a more complex topic. We were talking about advanced applications for the qualified business income deduction. That's also called the QBI or Section 199A deduction. It's a tax deduction for self-employed people that started in 2018. And I was doing a fairly advanced presentation about that. And people didn't really seem to be following me. And I was trying to explain how that interacts with your solo 401k or your other retirement plans. And people seemed lost. And so I said, how many people have a solo 401k? And this was a bigger group. Nobody raised their hands. And then it turned out most of them didn't have a retirement plan at all. And then I thought, oh, well, no wonder they're not following these advanced topics. They don't even have a retirement plan. So I said, well, what's your plan? How are you going to retire? And one woman said, she just said, sell the big one. And then she started to giggle. So I thought, uh-oh, that's kind of magical thinking. I mean, we would all like a little magic in our lives, right? Maybe we'll win the lottery. Maybe an unknown rich uncle will die and leave us a big windfall. Sometimes magic happens, but we don't want to count on magic. We need to do some planning. And so it is very important to make sure you have a plan for your own retirement. Okay, so these are other possibly relevant factors. If you have a spouse with a retirement plan, sometimes maximizing that before you fill up your own can make sense for various reasons. All right, employer plans, 401ks. Now, you just told me, several of you, that you're self-employed. So I'm going to go somewhat quickly through this other type, through people who work for a company. But a 401k, the information is relevant because if you have a solo 401k, it is a 401k. That's the self-employed 401k. Whether you work for another company or you work for yourself, a 401k has a lot in common with other 401ks. So almost any kind of company can have a 401k. 401k will almost always, well, it will always have a pre-tax option because traditionally they were pre-tax money. But these days, 401ks usually also have a Roth option, meaning you can put some of your money into the pre-tax part, some in the Roth part, or all in one part or another. Some may have an after-tax option. Now that is a little complicated. And if you're paying attention, as I know you are, you're thinking, yeah, you just told us Roth was after tax. We know what you mean. But unfortunately, the terminology is not always helpful. Some 401k plans have a third category. They will say you can put money in the pre-tax, you can put money in the Roth, or you can put money in a third category called after tax. And again, Roth money is after tax, but this is a third category called after tax. Not very helpful. If I ever run the world, I'm going to fix the words first because so much language is so confusing. Okay. Now, if you have a solo, probably, or self-employed 401k, probably you don't have this after-tax option. If you work for a big company, you may have that option. If you do, that's very valuable. The after-tax option is what allows you to do what we call the mega backdoor. And that is a way to get a huge amount of money into a 401k. So I'm not going to dwell on it today because I don't think many of you have this option. But I'll just say, if you work for an employer and you have a 401k plan, I want you to ask one of your colleagues or ask your HR department, hey, can we do the mega backdoor? It's incredibly valuable, but probably doesn't apply unless you work for a big company or work for a university. They often have that. Okay, moving on. 457Bs are for nonprofit and government entities. They're very valuable. The reason 457Bs are great is that there's a limit to how much you can put into a 401k. If you have a 457B, you get another version of that limit. You get to, this year, if you are under 50 in 2026, you can put $24,500 into a 401k. And even if you change jobs 3 times this year, you're still limited to $24,500 in your 401k. But if by magic one of your companies, one of the people you work for is a nonprofit organization and they have a 457, you get to put another 24/5 into tax advantage retirement planning. That's why 457s are great. Since I don't think you have them, we won't spend more time on that. Okay, here we are at the limits. In 2026, under 50, you can put in $24,500, pre-tax or Roth or some combination of the two into any 401k plan. Your plan won't change that rule because this is a federal rule, 24/5. Last year, it was 23/5. So if you're thinking, oh, I just did my taxes, that's not the right number. It's because that is tied to inflation. So it usually goes up a little each year. 24/5. Now, if you will be 50 by the last day of this year, if you turn 50 anytime in 2026, or you're already 50 or over, you get to put an extra 8,000 in. That's the over 50 catch up. So if you are 50 or more, you can put $32,500 into a 401k plan, pre-tax or Roth or some combination. If you work for a company, they may or may not match those contributions. What that means is many companies say, hey, if you put in X dollars, we will match your contributions up to some percentage of your salary. That's a great, great deal. That's free money. Always get the match. Even if you feel like you can't afford to save, you must save enough to get the match because it's free money. There's no reason not to get it. Let's see. There's a withdrawal. You can make withdrawals after you leave the company with a 401k, but there's a penalty if you take money out before age 55. The penalties are, let's see, I have a slide later, but the penalties are if you are not of the right age, you have to pay, you always have to pay tax when you take money out of a pre-tax account. But in addition, if you are not the right age, you have to pay a 10% federal penalty and a 2.5% California penalty. We do not like penalties. You don't want penalties. So you don't want to take this money out early. Now, you may very well be saying, why on earth did she say 55? The age is 59 and a half. You've probably heard that, and you are correct. 59 and a half is usually the age for penalty-free withdrawals from any type of retirement account. That's still true. The reason this says 55 is if it's your last job and you have money in a 401k, you can take that money out of that 401k from your last job as long as you're 55 or older. This is an Obama era rule, came in around 2009 when he was looking for all kinds of ways to help people through the awful financial crisis. If you're old enough to remember 2008 and 2009, things were scary. Stock market was crashing. People were losing their jobs. It was our modern recession. At that point, if people got laid off, say at age 55 or older, they may not have wanted to be retired, but they might have ended up being retired anyway, and because they couldn't find another job. So if it's your last job and it's a 401k, you can take money out without penalty if you leave after 55, even though the normal age is 59 and a half. All right, a few recommendations, because I tend to talk about all kinds of facts and figures and things and names and rules, and I want to remember you're looking for action items. So here are some specific actions. Whatever you do, get the full employer match. No matter what you have to do to save enough money to get whatever match they're offering, that's free money. You need to get that. I want you to maximize your contributions if at all possible. Get up to that 24/5 or get up to the total amount in IRAs. And notice I said, even if you're saving for your children's education. This is because if you have children and you want them to go to college, I commend you and I'm really glad you're saving money for their education. That's fantastic. However, if there's any chance your children are going to qualify for financial aid, you're going to fill out the FAFSA, the government form for financial aid, something or other. And on that form, you're going to have to list all of your assets and your income and other things like that. The assets that you have in retirement accounts do not count against you. So if you have maximized your 401k, let's say you have $1 million in tax deferred savings, that doesn't count. But if you have $1 million in the bank, not in a retirement account, that's going to reduce your kid's ability to get financial aid. So I like this rule because we want you to take care of yourself first. If you save all your money and send your kids to college and then you can't afford to retire or you can't take care of yourself, that's not good for anybody. So as on an airplane, when you're supposed to put on your own oxygen mask first, I want you to save for retirement first before you start saving in a 529 plan for your kids' education, before you fill out that form. Okay, recommendation number 3, try to contribute the maximum amount allowable every year. Now, if you feel like there's no possible way I can spare $24,500 from regular take-home pay for grocery money, I feel you, I understand. I push everybody towards the maximum, but remember that it is a maximum. You know, if you feel like, oh my goodness, all we can possibly spare for savings this year is $10,000 or $5,000, do it. Don't say, oh, that lady said it had to be 24/5. No, that's a maximum. Anything is better than nothing. All right. I think, all right. Those are my 3 big recommendations. All right. Now, IRAs. So we just talked about 401ks. Those are workplace plans. Now we're going to talk about IRAs. First thing I want to point out is IRA doesn't stand for what you probably think it does. It does not stand for individual retirement account. The New York Times crossword got this wrong not long ago, and I haven't figured out the right person to write to and complain. Does not stand for account. The A stands for arrangement. What difference does it make? The reason it makes a difference is you might have lots of IRAs. You could have different accounts at different banks. Totally fine. But you have only one arrangement with the IRS. So in other words, if I can't open an IRA at Schwab and an IRA at Bank of America and put $8,000 into each one, because it's not per account. The annual limit is per your arrangement with the IRS. There are other reasons why it's important to realize that we think of all your IRAs, no matter how many you have, as one. There we go. Types of IRAs. Same as with 401ks. There's traditionals and there's Roths. Traditional is pre-tax money. Roth is after-tax money that's never taxed again. And then there's this other category with traditional IRAs. You can have a non-deductible traditional IRA. That is not super valuable. I don't recommend that. The only reason people would do that is because there's income limits on who can contribute to a traditional IRA. If you make too much money, you can't put money into a traditional IRA that's deductible. So you might do this, but I don't recommend it again. We have better options. And then there are 2 types of employer-sponsored IRAs, the SEP IRA and the Simple IRA. These 2 are a little bit weird. They're kind of a hybrid category because they are employer plans. Most employer plans are 401ks. These are both employer-based plans, but they're both IRAs. So in some ways they behave like IRAs. In some ways they behave more like 401k employer plans. These are the basic types. A couple of other subsets. There's a rollover IRA. That means you moved money from an old job. You rolled it from a 401k into an IRA. And there's the inherited IRA. The reason I said AKA BDA is that's what Fidelity calls them. If you have money at Fidelity, they call it a beneficiary distribution account. That's an inherited IRA. Inherited IRAs, the reason they're important is they have a different schedule for required minimum distributions. In other words, if your grandfather or somebody dies and leaves you an IRA, you will take required minimum distributions even though you are young, even though you're under 75. Inherited IRAs have RMDs right away. Okay, here's the rules. In 2026, if you are 50 or if you're under 50, you can put $7,500 in. If you are 50 or over by the end of the year, you can put another $1,100 in. So 50 or over can put $8,600 into an IRA. You can withdraw the money after you're 59 and a half years old with no penalty. If you do it early, these are the penalties. Not good. Don't pay penalties. Follow the rules. These are 2025 limits. I put them in just because I know some people only finished their tax return recently, and the amounts do tend to go up a little year to year. But right now, 7,500 if you are under 50, 8,600 if you are 50 or over. Now, tax implications on a traditional IRA. If you put in money to traditional IRA, it's deductible now, which means when you take it out, you pay income tax at your ordinary rate at that time. Now, income limits. So for an IRA, I'm just peeking. No, I haven't missed any new questions. Okay. For a traditional IRA that's deductible, they are relatively low income limits. IRAs were invented in the first place to help mostly self-employed people, people who didn't have access to a 401k plan at work. So for people who do have access to a 401k plan, you have to be fairly low income to put money also in a traditional IRA, which is fine. Because if you have access to a 401k plan at work, I want you to fill that up. That's easy. It's simple. It's great. There's more money involved. Remember, if you have a 401k plan, you can put 24,500 in it if you're young. This plan, you can only put 7,500 in. So if you have access to a retirement plan at work, fill that up first. Then, if you qualify, you may want to also contribute to an IRA. But again, in California in 2026, these are fairly low income limits, right? If you're married filing jointly, chances are the two of you together make more than 129,000, and then you are not eligible to contribute to a traditional deductible IRA. You can contribute to a non-deductible IRA if you want. There's no income limits, but your contributions are they're not that helpful. They don't save you tax now, and the investment earnings will be tax deferred and taxed at withdrawal. It will also be complicated to keep track of this though, so I don't recommend that. Now we have Roth IRAs. They have higher income limits, which is helpful. Again, tax-free growth for the rest of your life and 10 years beyond. You can leave your Roth IRAs or your Roth 401ks and leave them to your heirs. They never pay tax on them either, but they do have to take them out, the money out over 10 years. All right, here's the Roth IRA rules. 7,500 is the limit if you're under 50, 8,600 if you're 50 or over. Now, first, it's important to note that this is your total amount that you can put into any IRA. So it doesn't mean you can have a Roth IRA at 7,500 and a traditional IRA at 7,500. It means that 7,500 is the total amount you are allowed to put into your IRA arrangement. So whether it's all in a Roth, all in a traditional, or some of both, 7,500 is your limit. Same rules as before, kind of, that you can withdraw without penalty after you're 59 and a half years old. Roths have another twist, which is that the money should have, or you should have had a Roth IRA for at least 5 years. Now, an interesting point about that though, is it does not mean every dollar in your Roth IRA has to been in for 5 years. In most cases, it just means you had to have had the account open for about 5 years. So if you opened a Roth IRA when you're 18 years old, you never have to think about it again. You're not taking that money out before you're 23. And even if you're relatively old, let's say you're 65 right now and you're going to contribute to a Roth IRA, I think you will find, as a relatively old person myself, I will tell you time goes so fast now. 5 years does not even seem to matter. It's not a reason to not get started. Also, it's not quite 5 years because it is the 5-year clock, we call it. It starts on the first day of the year for which you made a contribution, not the year in which you made a contribution. In other words, let's say it's April 15 of 2025. As you probably know, you can make Roth contributions. There's a little grace period after the end of the year. So for April 15 of 2025, I could put in money for 2024. Maybe I made money in 2024. I wasn't sure if I could spare it. I wasn't sure what tax bracket I was in, things like that. So I waited till after the end of the year. I did my taxes. And then April 15, 2025, I said, I'm putting in money for 2024. My clock started January 1st, 2024. So that's a year and a quarter before I even put the money in. My 5-year clock started. So most of that is just to let you know this is important to know about, but it's probably not going to cause you any trouble, that 5-year clock. All right. The income limits for a Roth IRA, these are higher than the income limits for the traditional. If you're married filing jointly, I wouldn't be surprised if you make less than 242 combined. Or if you're single, you could be doing quite well and still have an income of less than $153,000. So these are the income limits for a Roth IRA. One important note here, if you're married filing separately, you really can't contribute to any IRA. There are many good reasons not to file separately. So if you're considering that, you probably should not. But that's a side note. We could talk about marriage more another time. But basically, remember, filing separately, you cannot contribute to IRAs. Roth IRA, these are reasonable limits. You may be able to contribute to other things and also contribute to a Roth. Also, remember those two footnotes up here? These two footnotes. These are not relevant to the Roth IRA, only to the traditional IRA. So in other words, the traditional IRA, the income limits only apply if you also have a 401k plan at work. The Roth IRA, that's not part of it, which means the Roth IRA doesn't matter whether you have a 401k plan or not. These are the income limits. But there are people who can afford to put in the full maximum amount to their 401k, still want to save more for retirement. They can then put money in a Roth IRA as long as they are under these limits. Okay. Tax implications. In the year you withdraw from a Roth IRA, you pay no income tax at all. I've said that a number of times today. I'm not going to apologize for being repetitive because certain things are very important and also some things are kind of complicated and we don't get it the first time. There's other things I'm going to repeat also. So this is the great thing about Roths, and it truly is great. You can have a lot of money in a Roth IRA and never have to worry about tax again. That's fantastic. Okay, now we're into what I think will be a big topic for a lot of you. We've got all the groundwork laid now. We know what's the difference between Roth and traditional. We know about income limits, things like that. Now we're going to talk about the best plans for small business owners. Simple IRAs, there are a couple of acronyms before I couldn't name for you, like IRMA. So this one I spelled out. The SIMPLE stands for Savings Incentive Match Plan for Employees. These came into existence in the early 90s, I think 1994. And they are easier than other 401k plans. I started a couple of these for nonprofit organizations I worked for in the 90s because they were companies. Back then, it was not always assumed that every company would offer a 401k. Now it usually is assumed. If you get a job offer, there's probably a 401k. This was a relatively inexpensive way for the company to start offering some kind of savings for employees. It might make sense for you. Here's the limitations. You'll notice the maximum contributions are less. It's not 24,500, it's 17,000. There's an over 50 catch-up, but also not as high. These things are pretty similar to the others. These are only simple IRA is only available to a small company with 100 or fewer employees, and they are available for self-employed individuals, but we have some better options. So why would anyone do a simple? They're relatively easy to install and administer, easier than a company 401k. They're inexpensive to maintain. So again, if you're a business owner with employees, this is easier than starting a 401k. Minimal reporting, that's important. There's some flexibility about contributions. In other words, you don't have to contribute every year. And employees can defer income to the plan, and there's a Roth version. If you are the employer, you're the business owner, and you're thinking about, should I do this for my employees? It is important to note that the employer must make a contribution to all employees' accounts every year, or almost every year. I said you can opt out in certain years. It's a fairly small amount, but you do have to contribute 3% or 2% of compensation of salary amounts for each of your employees. Okay, now, as I said, that is less popular than these other two, particularly for people like me and some of you who are sole proprietors and work for ourselves only and have no employees. So here we are. These are the two big types, the solo 401k and the SEP IRA. SEP IRA stands for Simplified Employee Pension. I usually think in my head, it's self-employed, but it's not. It's Simplified Employee Pension is what it stands for. Note that it is an IRA. Also note the word pension is not always used in the same way. When I hear pension, I think defined benefit plan, like the old style type of pension where your company just promises you amount and you don't have to save anything. But there's a law called ERISA, came in 1974, ERISA. Let's see if I can do that one. The Employee Retirement Income Security Act is what it stood for. ERISA is the law that protects our retirement savings and that defined the rules for lots of these types of things. Under ERISA, they use the term pension to mean any type of retirement plan. So that's why that's a little confusing. Okay, for a SEP IRA, um, if it's just you, you're welcome to do this, and the amount you can put in is the smaller of 20% of your business's net earnings, or $72,000. Note that there's no over 50 catch-up. Can't put in any more when you're over 50. This could amount to a lot more money than an IRA, right? Let's say you are self-employed, you don't have any official plan, you want to put away some money in a tax-deferred way for retirement. You're welcome to open a traditional IRA. Let's say you're self-employed, you have no retirement plan. Remember, for a traditional IRA, if you don't have a 401k at work, we don't need to worry about your income limits. There's no income limits for a traditional IRA if you don't have access to a workplace plan. So if maybe it's your first year in business, you don't even have time to think about setting up an official plan, you just want to save a little money. You're welcome to open a traditional IRA and put $7,500 in it. That's great. It's a great start. But if you want to save more money, the SEP IRA, remember, possibly up to $72,000. That's a very big difference in how much income you can shelter. Okay, these rules are exactly the same as for other IRAs and 401ks. You can withdraw the money without penalty after you're 59 and a half. These are the penalties if you have to deal with them. Now, one interesting thing about the SEP IRA is that there are no employee contributions allowed. If it's just you, if you're a sole proprietor and you have no employees, who cares? It doesn't matter. But be aware that you are contributing only employer money. You're contributing as the business owner, not as the business worker. Why is that relevant? Well, that explains, for one thing, why there's no over 50 catch-up, because you're not contributing employee earnings to it anyway. It doesn't matter how you are. It's an employer-sponsored plan. One good thing about them is they are easy to establish. You can set this up not only 3 months later, 3.5 months later till April 15, but if you file an extension for your taxes, you can wait till October to set this up for the prior year. Not recommending procrastination, but it's a flexible plan in that way. It allows bigger contributions, obviously, than a traditional IRA, and it's very flexible. Excuse me. I will take a cough drop so I don't cough on you. Very flexible. You can fund it this year, skip it next year, whatever you want. Now, disadvantages. No over 50 catch-up. Excuse me, no employee contributions. And if you have employees, you must contribute for them if they meet certain criteria. Here are the criteria. If somebody's working for you, they're over 21, they've worked for you 3 of the last 5 years, and they've earned at least $800, then you have to make a SEP IRA contribution for them. So it's good for self-employed people who have employees, because if you have employees, you can't do the solo 401k. It's especially good if your employees are young, part-time, or temporary. Here's a real-life example. Excuse me for this. I tend to start coughing when I talk too much, so I apologize for that. But no, it's not going to look cool on the video. I have a brother-in-law, my sister's husband, who used to run a jewelry store. He was very independent. He ran a little shop by himself. He did all the fine work himself, but he hired some college students over the summer sometimes to help with things. He hired part-time delivery people. He was a perfect candidate for a SEP IRA, because none of those people, some were over 21, none of them came back for 3 years. They were just college students coming in and out. So he was able to open a SEP IRA, which is pretty simple, save tax deferred money for himself and his family, and not worry about having to contribute for other people. So that was a good plan for him. It worked out well. Now we get to the one that is currently my favorite type of plan. These have become very popular in recent years. The solo 401k. Note this key line though, this is for people without employees. There's one exception to that, and that's your spouse. If you have a company that you and your spouse own jointly, or you own a company and you hire your spouse and nobody else, that's fine. But if you hire your domestic partner or your child or your neighbor or your boyfriend, those people are not spouses, and you can't have a solo 401k. These are other names for the solo 401k. Schwab calls it an I-401k. Vanguard calls it an individual 401k. Fidelity calls it a self-employed 401k. These are all the same thing. Okay. So I tend to call it a solo, but don't be confused. If you're doing one of these things, it's exactly the same thing. It can cover one business owner and one spouse. And that is the only people it can cover. Here's the rules. Maximum contribution in 2026 is up to $72,000, or if you are over 50, it's $80,000. So you're maximizing your opportunities for savings here. This is more than we've seen in any other type of plan so far. So if you earn a lot of money, I want you to see if you can do this for sure, because sheltering 80,000 from taxes is a big deal. These rules on the right, exactly the same as the rules for other types of plans, right? 59.5 penalties for early withdrawal. So what's a solo 401k? Well, it is a 401k. In most cases, it's just like a 401k. The rules are the same in most ways. The reason we call this thing a solo is basically the paperwork is simpler if it's just you. If it's a plan for just one person or that one person and her spouse, we don't have to do as much paperwork. Basically, as long as the total amount in the account is less than $250,000, no annual reporting for the 401k. You don't have to do any testing. If you worked for a big company, and let's say you were the benefits manager for a company that had a 401k, there's quite a lot of testing and analyzing you have to do of your 401k plan each year. You have to make sure it's not a top-heavy plan, that the top executives aren't getting more benefit than the smaller, the less important people, all that kind of thing. Solo 401k does away with almost all those reporting rules, so it's way easier. Now, if your solo 401k plan, I'm going to say when, not if, when your solo 401k plan grows to a total balance of more than $250,000, you do have to start filing an annual report. It's called a Form 5500. It's not a big deal, and there are specialists who can help you with it if you need to do that. But under 250,000, which is where it will be in the first few years at least that you have one, almost no paperwork at all. That's what's great about the solo 401k. Easy to establish and inexpensive, biggest contributions possible for a business owner, and totally flexible. Maybe next year I want to buy a house and I don't want to put money in tax deferred savings. I want all my cash take home. I just skip a year, no problem. Unlike, again, a formal company plan where you have promised to fund things. More solo advantages. There is the over 50 catch up, which there's not for the SEP IRA. You can set your plan up with a Roth option, which is great. So you're flexible each year. You can decide which portion of my contributions will be pre-tax, which portion will be Roth. You can set up the after-tax option to do the mega backdoor if you want to. I'm not sure it's worth the trouble, but you can. And you can even set up your plan to make loans possible. So you could borrow money from it if you needed to. Here's the contribution limit. Elective deferrals. That is the amount that I also sometimes call employee contributions. Now, as a business owner, I am the employer and I am the employee. I'm one person filling two roles. My employee deferral can be up to 24.5. I'm 50 and over, so it's actually 32.5, 24.5 in plus the $8,000 over 50 catch up. So I can put in 32.5 as my employee deferral. Then, because I'm also the employer, I can then put in 25% of my compensation or my net income from the business. So if my business earned $100,000 this year in net income, I can put another 25,000 into this plan. If my business earned $500,000, I don't know what the exact cutoff is, but definitely $500,000, 25% of that is plenty to get me to the total of $80,000. So I can make a large employer contribution, and I can do this after the end of the year. Basically, you kind of have to. You have to finish doing your tax return to figure out how much was my net business income, how much can I put in this plan. If you hire a tax professional, ask them, how much can I put in my retirement plan? They'll probably tell you anyway, but ask them. If you use tax software and do it yourself, After you fill out your Schedule C, there's going to be a box you can check that says, tell me the maximum amount I can put in my retirement plan, and then do it. All right. So these are the two most popular self-employed plans. If you have been self-employed for a while, there's a pretty good chance you have a SEP IRA. They've been around a little longer. SEP IRAs were a great plan. And before solos got popular, this is what self-employed people did. They had SEP IRAs. So if you have one, that's great. Don't worry about it. It's not a problem. You cannot contribute to both in the same year, but you can have a SEP that sits there growing while you now contribute to a solo. I do, and many people I work with do. I started a SEP IRA 20 or 30 years ago when I was just earning a little money doing some freelance work at something or other. I started a SEP IRA. It's been growing quietly on its own, even though now I contribute to a solo. Totally fine to have both, just contribute to only one in any given year. So I bring this up now in part because maybe you have a SEP IRA and you're thinking, oh, she just said solos were better, but it's too late. I already have a SEP. It's not too late. Just start a solo this year, contribute to solo this year, and just let your SEP quietly grow in the background. Totally fine to have both. Now I'm talking about things right now that are relevant to all of us. So I'm checking my question box of the chat box. Do feel free. If I've said anything that doesn't make sense or anything you want to delve deeper into, go ahead and remember you can put that in the chat. All right. So the difference between a solo and a SEP. You notice it says here, a SEP is purely a profit sharing plan. What that means is that a SEP is only employer money. And that's one reason you can't put in as much, because there's no over 50 catch up, because it's only company money. A solo includes both the employee deferral and the profit sharing company contribution. It's easier to get the maximum amount into a solo because of the salary deferral. The solo includes the $8,000 catch-up. The solo allows for possible loans, and possibly you can make after-tax contributions in addition. For self-employed people, the solo is usually the best option, but if you employ anyone beyond yourself and your spouse, you cannot have a solo. That's the basics. Now, supposing you're saying, okay, I get it, a solo is a good idea. I don't want you to just put it in the back of your head or put it on a list and think, oh, we'll deal with that later, because you're going to be busy later. So I'm going to tell you it's actually quite easy. To set up a solo, you will need an employer identification number. You may already have one. If you already have one, totally fine. You're all set. If you don't have one, they're free. I love things that are free. And it should be pretty easy. You go to irs.gov and you apply for an employer identification number, or EIN, sometimes called a tax ID number. It'll be 2 digits and then I think 7 digits. What's good about having that? First of all, it's free and it's easy to get. Second, you need it for the solo 401k. But one other reason it's good to have it, if you have your own business, is an EIN can often be substituted for a social security number. And we know it's important to protect our social security numbers. So it's kind of nice to have this separate number that represents your business. It doesn't change much of anything. It doesn't change the fact whether you fill out a Schedule C or not. It doesn't matter if you have an LLC or an S Corp. It doesn't matter. But for example, sometimes I do work where somebody sends me a 1099. I have to fill out a W-9 for them with my personal information. I would rather not keep sending people forms with my social security number on them. I can use my business EIN. So it's a great thing to have. Step number 2, after you get that, you choose a provider. My current favorite provider is Fidelity. I used to say Vanguard. Vanguard was a great place to have a solo 401k. But then they went out of the business. They stopped doing it. They sold that line of business to Ascensus. I didn't love Ascensus. My plan, because it was at Vanguard, got automatically transferred there. I didn't love it. I'm not saying they're bad. I'm just saying I found their interface difficult. They didn't keep track of the same things I wanted to keep track of. Their websites were confusing. I didn't like it. So for a while, I didn't leave because I didn't have a better idea. But recently, Fidelity added a Roth option to their plans. Fidelity didn't used to allow you to have a Roth in a solo 401k. So that didn't work for me. Now they do. So that's my favorite place now. But all of these are reputable companies. Any one of these would be more than happy to help you with your solo 401k. And by the way, if you want to do anything complicated, like adding loan options or adding mega backdoor after-tax options, if you want to do anything complicated, I would contact mysolo401k.net, because that's a company that does management for you, and they charge you a fee, but they'll be more helpful with forms and things like that and more complicated situations. Fidelity, you can have a pre-tax and you can have a Roth, and there's no fees, which I love. I hate paying fees. But anything's complicated, Fidelity's not really going to help you with that. You don't need anything complicated. So anyway, all of these are reputable companies. Just choose one that you like for whatever reason, and then fill out the application and get started. So these are the only 3 steps you need to do. And it's not very hard. I did get some questions. All right. Somebody says, with a solo and a SEP, when I reach 50 years old, can I continue to contribute? Yeah, you can continue to contribute to a retirement plan as long as you have earned income. If you're still running your business when you're 85 years old, you can still contribute, not a problem at all. Okay. Now there are rules about when you have to take money out. You may still be subject to required minimum distributions, but there are some situations where you'd be contributing to the plan and taking required minimum distributions. Might sound a little bit complicated, but it's fine, and it still is going to reduce your tax burden to be doing both. So yeah, there's no problem with contributions after you're 50. Number 2, is there an age limit? Oh, is there an age limit for contributions? No. The only limit on contributions is, are you earning income? That's all. Okay, next topic, the Savers Credit. This is a little bit separate, a little bit different, but I always like to mention this because the Savers Credit is a valuable money that may be available to some people, and it's for low-income people. I realize you're probably not low income, but sometimes we are. Sometimes we're in the process of starting a business and we might have a low-income year. And also, you may have children who are just getting started or friends who are low income. They probably don't have a financial advisor. So I like to always tell people about things like this and say, please share this information. To be eligible for the Savers Credit, you have to be at least 18, not claimed as a dependent by someone else, and not a full-time student. So if your children are in school, this is probably not for them. But if they're young adults getting started in their career, it is. Now, the credit is 10 to 50% of contributions that you make to a retirement account, up to $2,000 per year. So in other words, there's a potential for $1,000 of free money for people who contribute to retirement plans. The reason I like this is life is complicated. Money can be short. It's very easy to say, oh, I don't want to worry about retirement plans. I'll do that when I'm old. I'll do that when I'm rich. I'll do that later. I don't earn enough money yet. This is to encourage people to start saving for retirement right away. To remind you that it does make sense to start early, even if you feel like, I don't have enough money yet. It's to help people without much money save more money. So let's say you are married filing jointly, and your adjusted gross income is, I'm going to jump over here. You're married filing jointly, your adjusted gross income is less than $80,000. Go ahead and contribute to your retirement plan, even though it feels like you can't really spare the cash, and you will get a credit of 10% of what you contribute. So let's say you contribute $2,000 to an IRA, you get a credit of $200. That's free money. Now we're going to look at another part here. Let's say you are single and you're making less than $24,000. 50% of your contribution you get back as a credit. A credit is free money. That means you fill out your tax return, you say, I contributed $2,000 to my retirement plan, whether it's a 401k or an IRA, doesn't matter, and I make less than 24,000, bam, you get $1,000 back in your taxes. So very valuable. And some of these numbers are not that low, right? It's for low income people, but married filing jointly, you might some year make less than $80,000. Maybe one of you's out of work, maybe one of you's starting a new business. These do apply to people. So I want you to be aware of that. If you forget the details, no problem. Just look for Savers Credit on irs.gov. All the rules are there, and they update these income amounts each year. New topic. Peeking at questions. New topic, required minimum distributions, commonly called RMDs. This is about when you have to take money out of your retirement accounts. Now, I've talked a lot about why Roth accounts are great, the fact that you can have a lifetime of free growth. Another great thing about Roth accounts is there are no required minimum distributions in your lifetime. That's great. That means money in your Roth accounts is totally flexible. You can decide to spend it later. You can decide to save it and leave it to your kids. You do not need to take RMDs from Roth accounts. If it's a pre-tax account, though, you do have to take required minimum distributions. Traditional IRAs, SEPs, simple solos, inherited IRAs, all these things have required minimum distributions. When do you have to take them? Used to be sort of easy. For years and years, RMDs started at age 70 and a half. That was a little confusing because I had to figure out what year do you turn 70 and a half. That took a little thought. But now, if you are, that's changed a couple of times lately. There were several changes in recent laws. So first, they changed everybody from 70 and a half to 72. Now it's gradual. Now, if you were born 1950 or earlier, your RMD age is 72. If you were born in the 50s, it's 73. For a lot of us born 1960 or after, don't have to worry about RMDs until you're 75. That's great. What's great about it is it gives you more flexibility. So remember, you can take money without penalty from any type of retirement account at age 59 and a half or older. So between 59 and a half and 75, totally up to you. Take the money out when you want to, take the money out when you're in a low tax bracket, do whatever you want between 59 and a half and 75. Okay? 75 is when you have to take money out, but you can start sooner. So you have a lot of flexibility in those years, and that's a great time to sort of plan ahead. All right. RMDs from an inherited IRA are a little more complicated. The rules have changed several times about that lately. And so it can be confusing, and there's a lot of, let's see, loopholes isn't the right word. There's a lot of sort of nuances to it. Different people, different rules apply. So if you have an inherited IRA, I would, and you, if you have a tax advisor or a financial planner, check with them about your inherited IRA and make sure you understand your RMDs. If you don't have a professional person like that to help you, it's okay. Then talk to somebody at the institution that's holding your inherited IRA. If it's at Schwab or Fidelity or wherever, Raymond James, E-Trade, they understand that. They have people, and they probably will not charge you to talk to you about your inherited IRA and make sure you understand your RMDs. The important thing is if you inherited it, your age is probably not that important. In other words, even if you're young, you probably have to take RMDs from an inherited IRA. It's fine. It's still really great that you inherited it. You just might want to do a little tax planning to make sure you're taking this money out appropriately. For example, in most cases of an inherited IRA now, you have to empty that account within 10 years. And sometimes with an inherited IRA, you also have to make sure you're taking out an amount that's based on your life expectancy each year. So check with someone specifically about your inherited IRA, but be aware that you are responsible for taking RMDs. And while I said your institution will probably be happy to help you, Schwab has a great calculator online, for example. You can plug in the information and figure it out yourself. And if you ask somebody at Vanguard or E-Trade or Morgan Stanley, they will be happy to help you. However, if you go back to one of those places later and say, hey, I inherited an IRA years ago and you didn't tell me I had to take RMDs, they will be very quick to remind you it's not their job, it's your job. You are responsible for knowing about RMDs and taking your RMDs. They will help you calculate them, but they will not be nice if you try to blame them or sue them later. It's your responsibility to be aware of this. All right. Words matter. I already mentioned one of my favorite bugaboos about that, the fact that IRA stands for Individual Retirement Arrangement. That's important because all of your IRAs kind of count as if they're one. Other words that matter: rollover, contribution, conversion, distribution, and recharacterization. Each one of these has a different meaning, and people often use them somewhat carelessly or they're just confused. The reason they're important is they each have different tax implications. A rollover has no tax implications. Rollover means I have money in my 401k, I left my job, I want to move it into an IRA. As long as I do that properly and everybody knows it and I follow the rules, I can move that money from the 401k to the IRA as a direct trustee to trustee rollover. There are no tax implications. It's not a cash out. It's fine. You will get a Form 1099-R at the end of the year that says you rolled X dollars, but it'll probably have a box check that says taxable amount not determined. As long as you can prove that it was a direct rollover and you didn't take any money out and spend it, probably no tax. Contribution is what we've been talking about mostly today. That's you putting money in. A lot of rules about who can contribute. Remember, your age matters, your income matters, whether you have a job matters. That's the contribution stuff. Conversion is an important topic some of you may be thinking about. A lot of people lately are talking about Roth conversions. A Roth conversion means you're taking money that you have in a pre-tax retirement account, you're converting it to a Roth. In the year that you convert, you pay full ordinary income tax on the amount you convert. Why would you do that? Because Roth IRAs are great. Many people would like to get more money into a Roth IRA. Remember the reasons they're great: no more tax ever for the rest of your life after you get the money in, and no required minimum distributions ever. So a lot of people would like to have a lot of money in Roth accounts. If you're in a very high tax bracket right now, if you're at the top of your earning potential, I probably would not do Roth conversions because you'd be paying ordinary income tax at your current rate, which is high. If you're earning a lot, you're in a high tax bracket. But if you retire, remember we've had that person before who retired at age 50, suddenly had no income at all. Their RMDs don't begin until 75. Their Social Security probably doesn't begin until 70. So they have 20 to 25 years in there when they may be at a very low taxable income. That's a perfect time to do Roth conversions. There's no income limits for Roth conversions. We don't care how much money you make, you can convert if you want to. There's no age limits. And so you can convert anytime you want. But the ideal time to convert is when you are in a very low tax bracket, because conversions do trigger taxes. Then we have this term distribution. A distribution means you're taking money out of a tax advantaged account to use for other things, like to spend or to give away or to do something with it. A distribution from a pre-tax account is taxable. A distribution from a Roth account is not taxable. Finally, recharacterization. That means you're undoing something you did, and you're really only able to do a recharacterization if you made a mistake. For example, if you put money into a traditional IRA and then you realized later, uh-oh, I made too much money, I wasn't eligible to do that. Then you need to call your institution and say, I made a mistake, please recharacterize that money. They will then either take it out of the traditional IRA and put it back into your regular savings accounts, or they'll recharacterize it. Sometimes people recharacterize a Roth as a traditional if they made the income limit for one and not the other, things like that. But those are really just to correct mistakes. So these are all kind of important. Where I often hear people confused is they'll say, oh, I rolled that money over to my Roth. I say, wait a minute. If you took pre-tax money and put it in a Roth, that is not a rollover. Okay, rollovers are very benign and simple, and they don't trigger taxes. If you moved money from a pre-tax into a Roth, that's a conversion. It might be a very good idea, but a conversion triggers taxes. One more key point about Roths. The whole point of a Roth IRA or a Roth 401k, the whole point is the tax-free growth over time. It can be incredibly valuable, but I want it to grow. If it's not growing, you're not getting your money's worth. Like if you just put money in a Roth IRA and then you just let it sit there in like a sort of checking account or something and it doesn't grow, you didn't get your bang for your buck. So as soon as you have money in a Roth IRA, invest it immediately. Usually what I invested in is an ETF or a mutual fund that invests in low fee, highly diversified US stocks, because over the long run, that is the greatest potential for growth. And you want your Roth IRA to grow as much as possible. It's also likely to be the money that you're going to use last. So you don't need to hold some cash in your Roth in case you need it. You need cash in your checking account to pay your bills. And you maybe need cash in a brokerage account, cash meaning a money market or a CD or something, or a high yield savings. You need that money that's accessible. But your Roth money, you're not going to spend it this year anyway. So we're not very concerned about whether Roth money, what happens in stock market ups and downs. Because if you're young, it's going to be a lot of stock market ups and downs before you're old. But we expect that if you're very young now and you're going to take this Roth money out later, there may be ups and downs, but I hope that over time, if you invest in stock market, it's going to be worth a lot more now than in the future than it is now. So that's why you do want to remember that's an important step. After you have the Roth IRA, invest that money. Okay, a few things that are new. And I have done this particular talk for the realtors before. And so if you came last year, first of all, thank you for coming back. Second, you may be thinking, oh, I already know all this stuff. So this is the chance to know some new things. There's this new extra catch-up. Remember I mentioned that there is a over 50 catch-up for IRAs and for 401ks. At the moment in 2026, if you're 50 or over, you can put an extra $1,100 in your IRA. You can put an extra $8,000 in your 401k. But now there's this weird new catch-up, just started this year, that says if you are between 60 and 63 at the end of the year, you can put, instead of your catch-up for the 401k, instead of being $8,000, it's going to be $11,250. Just for these 4 years worth of people. If you're already 64, you can't do it. If you're 59 at the end of the year, you can't do it. But it's an extra catch-up just for a small group of people. The amount didn't change from 2025 to 2026. 2025 was the first year it existed. It's the same amount now. So for 2026, it's 11,250 instead of 8,000, which means, do I have the total here? Yeah. For 2026, the total limit for 401k, if you are in that small age group, is 35,750. And you can do it. Yeah, okay, this is repetitive, same information. It's a little more detail on how they came up with that number, but that's the bottom line. It's 11,250 instead of 8,000 as an extra catch-up. So a chance to save even more money. Oh, another weird thing that happened this year, starting in 2026. So the 60 to 63 thing started in 2025. Starting in 2026, if you are what the government calls high income, which is not high income in California, if your income was above $150,000, starting in 2026, you're making your 401k contributions, the catch-up part of that must go into a Roth instead of a pre-tax. By the way, this is fine. Remember in the beginning when I said they're all good, pre-tax is good, Roth is good, it's all good. So don't worry about it, but just be aware, if you are contributing to a 401k, the first 24,500, your choice, put it in pre-tax or Roth or some combination, but the extra 8,000 of catch-up has to be in a Roth. Totally fine. I'll just mention as a side note, a friend of mine works for Amazon. Amazon, which you would think would have a really big HR and benefits department and lots of professionals who know what they're doing, they haven't figured this out yet. They have misclassified his catch-up contribution and put it all in pre-tax, and they need to fix that. Incidentally, along the way, he then got laid off. So now it's complicated. He needs to stay in touch with them and make sure they reclassify this, because the company is responsible for making sure that his catch-up amount goes properly into the Roth portion. It's all good, but it's a new thing to just be aware of. And it will apply to a lot of people, because in California, again, 150,000 is not a high salary, or yeah, high earned income amount. Let's see. This does not affect IRAs. IRAs, it's still entirely up to you whether you want to do the pre-tax or Roth, assuming you meet the income requirements. This is just for 401k plans. The catch-up amount has to go into the Roth. And that 150,000 that I said was the income limit. Sometimes people say, well, what do you mean exactly? Is that my quoted salary? Is that my adjusted gross income? In this case, it's your FICA wages. If you look at your W-2 and look at box 3, it'll tell you what amount counts for that 150,000. All right. I'm now going to give a summary of the key things that I think we talked about that are important. And then we have more time for questions. So as usual, I'm going to really encourage you, if there's something that you want to hear more about. And I'm going to actually, before I do this, I'm going to look back at your questions and see if there's anything I postponed. The feeling there was one thing you didn't go into detail on yet. No, what I thought I remembered, I didn't. Okay, so do add questions. We have time for them. But meanwhile, again, I know there's a lot of information. And so I want to focus now on, yeah, but what do you do? What actions should you take? This one I've not mentioned yet. It's super important. I want you to check your beneficiaries. I want you to check beneficiaries on every retirement plan, all your IRAs, all your 401ks, all your Roth 401ks, all your Roth IRAs, and all your life insurance accounts. If you have any life insurance plans anywhere, whether they're through your company or not, you need to make sure you have a beneficiary named on each one. The reason is that a beneficiary is the person who receives the money when you pass away. And even if you have a will, even if you paid an estate planning attorney a lot of money to make you an official will, your beneficiary designation overrides that. That's fine because it's very cheap and easy to check your beneficiaries. As I often say to people, you could be doing it right now on your phone without even being rude. You could just open up your account and check, have I looked at my beneficiaries recently? You don't have to pay a lawyer. You can change it any time. You can name as many as you want. For example, if you have 5 children, you don't have to choose one. You can say, I want my beneficiaries to be 20% to each one of those. Beneficiaries do not have to know who they are. You don't, let's say you have a giant IRA and you're leaving it all to your grandson. Don't worry that you're giving him an impetus to hurry you along towards the grave. He doesn't need to know. He doesn't know anything until after you pass away. Another important reason to have beneficiaries on your accounts is that they avoid probate, which means that when you pass, the money goes immediately from your account to whoever you named as a beneficiary. If you didn't name a beneficiary, the money just goes into your estate. And then it's complicated. It takes longer. It's public information. It's not private. It's going to cost a lot more and take a lot longer for that person to get their money. So it is very important to name a beneficiary. A final story about that, a beneficiary designation, as I said, outranks a will. So sometimes people will say, oh yeah, I have a will, everything's all set. They never recheck their beneficiary. It says their high school boyfriend. Well, guess what? Your high school boyfriend gets your IRA. I don't care if you have children going hungry. I've not seen somebody break something like that. Your beneficiary, whoever you named, gets it. So if you named your mother and she's since passed away, you need to update. Or if you named your boyfriend and you broke up with him, you need to update. But again, it's free and easy. So it's not a big problem to take care of it, but it can be a very big problem if you don't do it. So I'm going to harp on that a lot. Check your beneficiaries, even if you think you have done it. It's also very nice to have both a primary beneficiary and a contingent or secondary beneficiary on every account. What that means is maybe you want to make sure that your husband is the primary beneficiary. That's great. And he gets 100% if you pass away. But what about the unlikely event that you and your husband pass away together? Then who's the secondary? You want to make sure there's a plan in place for what if that first person is not available. So name someone as a secondary beneficiary. If the first person is alive, the secondary beneficiary never even knows. They don't have any status. They don't get any money. But if something happens to the first person, the second person is then in line. It's a very good idea. It's a simple type of estate planning, very easy to do and very important. All right. All right, here we come to our top 10 tips about what you should do. Never, never, never miss out on getting a company match. That means even if you have a 401k plan at work, even if you feel like, oh, I can't spare any take-home pay, do not miss out on the company match. Withhold at least enough to get the company match. Sometimes that means 5% of your salary. Sometimes it's 3% of your salary. Sometimes it's $10,000. Whatever you have to withhold to get the match because it's free money. Number 2, maximize your tax-deferred and tax-free savings each year. I realize some people say I can't spare that much take-home pay. I feel for you, but maximize as much as you can, but don't overdo it. So remember, if you're under 50, the maximum for a 401k is $24,500. If you're over 50, it's $32,500, unless you're 61 to 63, and then it's more. You can double check all those numbers, and I'm going to give you a summary of the numbers at the end. So know that, try to hit the max, but don't go over it. It can be very messy if people over contribute, and then we have to take some out when you're doing your taxes, or you pay penalties for over contributing. I've seen a lot of people lately over contribute to their health savings accounts. We didn't go into health savings accounts today, commonly called HSAs, but be aware of the limits. It gets so messy when people put in too much and you have to undo it or pay fines on it. They're very valuable plans. So I don't want you to be afraid of it. If you have an HSA or 401k, do maximize it. But I find that some people just assume their company will take care of it and that, or their bank will tell them won't let them contribute more to their IRA. This is another thing that's your responsibility. You need to know the limit. You need to tell your company when to stop withholding, or you need to tell your bank, put in X dollars into my HSA or my IRA. And don't assume they're going to stop you when you hit the limit. Be aware of the limits and don't go over them. Okay, item number 3, remember if you're saving for your children's education, fund your retirement plans first. Take care of yourself first. Good, I see a question about the mega backdoor. We'll get to that in a minute. Okay, number 4, when you leave your company, you do not have to roll your 401k into an IRA. There are pros and cons to rolling over your money from a 401k to an IRA. I'm going to send you through Elsie, when I send you some documents after this, I'm going to send her a chart I made about the pros and cons of rolling over 401ks to IRAs. There are various reasons why you might or might not want to do that. But my most important message is you do not have to roll it over. Used to be unscrupulous financial advisors would somehow find out who was leaving their jobs and they'd call you and they'd say, hey, you got to roll over your money to an IRA and then give it to me to manage. It is illegal for them to do that, to call you up and tell you that you have to roll it over, or to try to convince you that you should give them, let them charge you money to manage your IRA. There are some good reasons to roll over. There's some good reasons not to roll over. But my main message is keep in mind that you do not have to roll over. So don't be in a rush. Take your time. If you're leaving a job, take your time, read my chart about the pros and cons, and think about it. This is good news for a lot of people because, again, where I live near Silicon Valley, there's a lot of layoffs. Even good people lose their jobs frequently up here. And sometimes, they're in a tizzy. They got to tell their spouse, they got to figure out how to pay their bills. They got to figure out, are we going to take money out of our savings, how to look for a job. There's a lot to think about if you get laid off. You do not have to rush to roll over your 401k. Leave it alone. Let it sit where it is. It's probably fine. Okay. Next, if you're a small business with no employees, start a solo 401k. If you are a small business owner with employees, start a SEP IRA and fund that. If you have a 401k because you have a day job, or your husband or your wife has a day job, and you have a solo or SEP plan for your business, fill up the 401k workplace plan first. There are some reasons for that I can't talk about this fast, but fill that one up first. Then fill up your business plans that you own. If at all possible, if you can spare the cash from take-home pay, try to fund a Roth IRA each year if you can, in addition to whatever else you're doing. After your money is in a Roth account, remember to invest it aggressively. Aggressively means in stocks, doesn't mean rude. In the investment world, aggressive means stocks, conservative means bonds. Conservative doesn't have anything to do with your politics. There's a couple more vocabulary words I should probably put on my list so I don't confuse people. You can be a very nice, gentle person and still invest aggressively. And then see if your company offers a mega backdoor. So that's a good lead into the question I just got. But somebody says, what exactly is the mega backdoor? Is this an option only for employee? Can't read the whole question, but the answer is the mega backdoor must be offered through a company plan. So it doesn't apply to IRAs. And if you work for a company and they don't offer it, there's nothing you can do about it. But it is a very valuable opportunity that some companies are now offering. A lot of the big tech companies are. I think Apple, Amazon, NVIDIA, who else? Microsoft, I know, offers it. There's one big tech company that doesn't. And off the top of my head, I can't remember which one it is. But many big tech companies offer it. The University of California system offers it. The state university system offers it. What the mega backdoor is it is a way to get beyond that $24,500 limit. So the total amount that can be added to a 401k plan in 2026 for someone who's under 50 years old, the total amount that can be added is $72,000. Now, and if you're 50 or older, the total amount that can be added is $80,000. Now, you will remember that I just said the maximum you can contribute as an employee is 24.5. Let's assume you're over 50 right now. So the maximum you can contribute is 32.5, right? I just said that for pre-tax and Roth combined. And then your company may or may not make a match. So how do you get from that 32.5 maximum that I said you could put in to pre-tax or Roth? How do you get from there to $80,000 that I said that's the amount in the passive voice? That's the amount that can be added. So first of all, you see if there's a company match. So let's say, got my calculator out now. Let's say you put in 32.5 and your company gives you a match of $10,000. Now you've put in 42.5 or 42.5 has been put into your account. But I said 80,000 was the total that can go in. That means in this example, there's $37,500 of room. With most 401k plans, nothing you can do about that. But if your company allows after-tax contributions, then you can have withheld from your paychecks an additional $37,500 or whatever that gap is. You have that withheld in the after-tax portion of your company plan. Now, not super valuable to have money in after-tax accounts, right? After-tax means you paid tax on it already. But if you can then get that after-tax money converted to a Roth, you've got a large amount of Roth money growing tax-free for the rest of your life. Roth money, as we have said, is incredibly valuable. So the mega backdoor is a third category of contributions to a 401k plan that allows it. It's money you put in officially as after-tax and then immediately convert to a Roth. Some companies will do that automatically for you. Some companies will just within the plan, whatever money you put in as after-tax, they just convert it to a Roth and you're done. Some companies say you have to take it, that your after-tax money and roll it into a Roth IRA. It's all fine. Whatever the system is fine. Just find out if your company offers it. You just find out and then you do whatever they say and it's totally worth it. Getting large amounts of money into a Roth is a really, really good idea. One thing that's great about the mega backdoor, you're doing it through your 401k plan at work. There's no income limits, no complications about age limits or anything like that. It's just if you earn that much money and your company allows it, you can just get a lot of money into a Roth account. It's a lot easier than funding your Roth each year at $8,000 a year and trying to make sure you're under the income limits and all that kind of thing. So the mega backdoor, again, it's only available if your company offers it. If they don't, there's not much you can do about it. But the way to find out if they do is, first of all, you get your summary plan description. That's abbreviated SPD. If you work for a company that has a 401k, they have a summary plan description. They probably even gave you a copy of it the day they hired you, but you threw it away because it was so boring. So now you go to the company website, you look for the SPD, summary plan description. You skim through it and you see it will probably say you can make pre-tax contributions, you can make Roth contributions. Then you look and see, is there a third category? Do they also allow after-tax contributions? The official company plan will not use the word mega because that's kind of a slang term, but we have to use it because we don't have any other good way to describe it. So people commonly call it the mega backdoor, but the keywords you will look for in your plan is after-tax contributions. Now, the other best way, excuse me again, another cough drop. The other best way to find out if your company offers this is just either ask your benefits manager or talk to your most savvy colleague and just say to them, hey, can we do the mega backdoor? And there will be someone smart at your company who knows how to maximize this. Ask them, how does it work? How do I get this done at my company? Because the specific rules vary. See if I've got any more questions here. What exactly is the backdoor option? Okay, so that's the mega backdoor. Other things. And by the way, I'm going to work through a few more final slides here with some summaries and things, but we do have time for one or two more questions. So if there's anything I didn't get to, This is your last chance to put it in the chat and let me know. Questions. When should you start saving for retirement? The answer is right now. Try to do it today. If you're not already signed up for your plan, or you haven't already started a solo 401k, try to do it today. When I was an HR director, people would have all kinds of reasons like, shouldn't I wait till after I change jobs? Shouldn't I research investments first, understand the stock market? Should I wait? People often say things like, oh, things might be different after the election. Yeah, they will. They will be different. But you know what? It doesn't mean you shouldn't save for retirement. Politics and economics and things change all the time, but over time, some truths remain, regardless of all the day-to-day turmoil. We would like to retire someday. We would like to save taxes, and we expect the stock market over the long term to go up. What it will do tomorrow, I have absolutely no idea. But what it will be in 30 years, probably better than where it will be now. So no, you should not wait till any of these things, most especially that last one. You do not need to wait till you know what you're doing. Nobody fully understands the stock market. Just follow the simple rules to get started on retirement savings. Whether it's your 401k at work, starting a solo, contributing to a SEP, contributing to an IRA, get started right away. None of these are reasons to wait. The best time to start was 30 years ago. Second best time is today. And by the way, people do come to me about that. They'll say, oh, I know I should have an IRA, but oh, gosh, I should have done it when I was young. Why bother now? No, second best time is right now. We don't have time to worry about what we should have done, right? There's lots of decisions I wish I had made in my 20s that I didn't even know about. So what? We don't have time for that. Get started now. All right, what if you don't know how to invest your money in your retirement account? I mentioned this earlier. You do not have to be investment savvy, and you do not have to understand the fund options. If you want to choose specific funds offered in your 401k, that's fine. If you want to invest in your IRA, you have even more investment flexibility. Your 401k will offer a limited list of mutual funds. Your IRA, you can invest in almost anything. You can buy crypto in your IRA. You can buy a farm in your IRA. You can't buy your personal home. It has to be an investment, not a lifestyle asset. But you can buy a marijuana farm. You can buy an apartment building. So your IRA, you have lots of flexibility. Not suggesting you take advantage of that. I like low fee, highly diversified ETFs and mutual funds. If you don't have preferences for even those, now it would be very easy to say, let's just buy a US stock market fund and a US bond market fund. That's a good choice. That's totally fine. But if you don't even want to think about it to that degree, almost all 401k plans now have options for a target date or a lifestyle fund. And that means somebody else puts in a mix of US and international stocks and bonds. And not only do they choose a mix of things for you, they also adjust it as you get older. So when you're young, it'll be mostly in stocks. When you get close to your retirement age, it'll be mostly in safer things like bonds. So you're not so subject to the volatility. These funds have slightly higher fees than other things, but they're worth it. So do not worry that you don't know how to choose an investment. If you want to choose specific ones, go ahead. If you don't, choose one of these. If you want time to think about and research investments, fine. Choose one of these. Start today. Choose a target date fund. And then later, when you understand more about what you want to do, just move your money. As long as it stays in the retirement account, you can change your investments anytime you want with no tax implications, as long as you don't take it out of the retirement account. No tax implications to trading within the account. So this is the way to get started. Oh, this is me again. I realized from some of the things we talked about today, I'm going to send you a couple of these things through Elsie today. But if you want to ever visit my website, clarityfinancialca.com, these are all PDFs you can download. Tax return checklist. So I hope your taxes are done. But if you're doing your own taxes in TurboTax, I've compiled a list of the common problems and confusions that I've seen over time. If you're trying to do a backdoor Roth IRA, people make mistakes. And this is the chart I referred to earlier about when you leave a job, whether or not to roll over your 401k. I hope they're all useful. Now, if you wanted, and I will send at least one or two of them to Elsie so you'll all get it. But if you ever want to visit those, or you're interested in any other information on my website, feel free to visit anytime. I'm not here to drum up business. In fact, I should mention, I'm not taking any new income tax clients at all, possibly planning clients. But really, I just give you my website in case it's helpful. There's some information and some resources there, and I'm not going to stalk you, and I don't automatically collect your address or anything like that. Key numbers. These ones I kept talking about, 401k, these are what you can contribute. IRAs, this is what you can contribute. HSA, we didn't talk much about health savings accounts, but that's the one where I most commonly see people make mistakes and contribute too much or sometimes too little. HSAs, that's important to know. So those are the key numbers. These are some official websites that I find useful. The most important site to check if you're confused about something is irs.gov because they make the rules. So if I say something and the IRS says something else, they win. Okay, they're in charge. Also, a little bit of good news, the irs.gov website is very well written. I like to be able to share that fact because you might not expect it. Sometimes we have low expectations of government workers, but the IRS website is very well written. It's clear, it's official. That's the first place to check. If you have questions about California taxes, FTB stands for Franchise Tax Board, .ca.gov, that's the best place for that. SSA.gov is where you look for Social Security questions, and there's a link from there to Medicare.gov. Those two are intertwined, so Medicare questions are there. If I want to understand an investing concept or something, I find Investopedia usually has the best explanations of basic stuff I need to know. I also use Bankrate and Forbes. What I use Morningstar for is to check out funds. If I'm curious, what's in this mutual fund? What are the fees? Things like that. This free version of Morningstar tells you all that. If you are looking for a financial advisor, these are some good places to look. The CFP board at cfp.net, the Financial Planning Association. The Garrett Network is a network I'm a member of, and it's people who do financial advising on an hourly or a project basis, as opposed to the more common model, which is financial advisors keep a percentage of your assets. You might want that other model where they invest your money for you and they take a percentage, but that's pretty expensive and not everybody needs that. So if you're looking for the type who are willing to work with you on an hourly basis, look at Garrett. Always look for a financial advisor who is a fiduciary. That means they won't try to sell you products you don't need. And if you need a tax professional, whoops, here's the link for that. So we are pretty much exactly at our ending time. So I thank you very much for coming. I don't see any new questions. We will send you more information. And again, I'm going to be talking to Elsie about other topics to talk about next year, which I'm very much looking forward to. And we can consider, I don't know your relationship with Elsie and the other people, but if you have a chance to lobby for topics that matter to you, I certainly would like to make sure that I'm talking about whatever's most valuable to you. Okay, yes, Elsie's reminding us today's recording will be available in a few days. So thank you all very much for coming, and I hope I'll see you again.